Finally, we have some really good news to go over for Tesla stock investors. Finally, Tesla has done it. Starting today, Tesla is offering a loan rate of 0.99% APR for all new Model Y finance orders in the US. This promotional rate applies to finance terms from 36 to 72 months for new vehicles. Orders must be placed by May 31st, 2024 to be eligible. There's something about lowering the interest rate that consumers love. This is a popular strategy that Ford, GM, Toyota, basically every other automaker employs. And this will probably boost Tesla's demand for the month of May. For a little bit of context here, the Model Y long-range rear-wheel drive was $706 a month. Now it is only $600 a month, but that is not including the $7,500 federal EV credit or probable gas and maintenance savings. This is the first time from my knowledge, I don't remember any other time that Tesla did any kind of special financing offers like this for any of their products, so correct me if I'm wrong down below in the comment section. But this is probably just a test run to see if this does boost demand. If it boosts demand more than cutting prices, in which I think it will by a long shot, this could be a new popular strategy that Tesla starts to use. What Tesla needs to do is get on the TV and advertise this now super low rate, like every other auto company has done. You've probably seen 100 different ads offering 0% financing on trucks and cars on your television. Apparently, Ford probably needs to do more of this promotional advertising. In the news today, Ford has begun cutting orders from battery suppliers. This is now as EV losses are over $100,000 per car again. Elon Musk responds to this and says making a great electric car at a great price is extremely difficult. And that's why only Tesla and Ford have never went bankrupt. And there has been hundreds of car companies in the history of the US. Sawyer Merritt wrote a poll on X that says, if your Tesla FSD supervised free trial has ended, did you subscribe for the $99 a month service afterwards? 17.3% said yes. 21.6% said no, and 61.1% of you guys wanted to just see the results. There were 30,026 votes. That does equate to almost 5,200 people that voted yes. Just based on this poll alone, at $99 a month times 12 months a year, that's almost $6.2 million Tesla's going to bring in, and this was only a 30,000 vote sample size. Extrapolating those numbers a bit, and let's say you had 2 million Teslas that just got their free trial of FSD, the take rate appears to be a lot higher than it was before. But then again, this is a Tesla channel, and Sawyer Merritt mostly covers Tesla. Tesla Economics wrote this post on X and said how long-term Tesla investors will be walking to the bank when the first fleet of robotaxis are launched in the US. Elon Musk liked that tweet, the closest thing that he can actually do to agreeing with that statement. Again, keep in mind, Elon Musk is not really allowed to say much about Tesla specifically and potential returns and all of this because of that gag order essentially from the SEC. Elon Musk responded to this X post that said why it's incredibly stupid for Netflix to split into two companies. Elon Musk says, now apply this logic to Tesla, which keep in mind, this article was from 10 years ago or more than 10 years ago. It was posted September 19th, 2011. So Elon Musk is saying that Netflix was actually successful in its switch. So if you apply that logic to Tesla, it's implying that if Tesla did kind of split off, could be a big positive for Tesla. So pretty interesting for Musk, and we'll obviously have to wait and get more details on that. I personally think Mr. Musk is saying you should look at Tesla in terms of multiple different companies, but again, there could be different meanings or outcomes to that statement. On Friday, Tesla stock was down about 2%, and you did see a big outflow, about $427 million worth of outflows in Tesla. Keep in mind, if you look at the previous 4 days behind that, you were actually seeing some pretty big net inflows. $295 million on May 6th, $89 million of an outflow on May 7th, 76 million inflows on May 8th, and 124 million in inflows on May 9th. But on Friday, it was a big outflow. Keep in mind, the last 4 days for Tesla have been red. So you were actually seeing inflows on red days. Besides on Friday. On Friday, Tesla broke under its 50-day moving average. That could have something to do with it. And it actually in after hours broke under its 20-day moving average with the 0.5% decline that we've seen in after hours. So that sets you up in a precarious position heading into next week. Next week, we will have some pretty big events. Starting on Tuesday, Jerome Powell will be giving a speech. Now, I want to pay very close attention to what Powell says here because the economy is starting to weaken. It's clear. Very clear to me, to others like Meet Kevin and other people in this, I guess, retail community. It's clear. The Fed on Friday sounded like they don't even know if we're at neutral yet. That maybe there's not enough restriction on the economy. Maybe they may need to raise rates again. That's how the Fed sounded. Fed Cook, Fed Kashkari, Fed Bowman on Friday. That's insane. So I want to hear from Powell if he's more dovish or more concerned about the economy. That could be a heads up for what to expect the following day. On Wednesday, we're going to get CPI numbers that will be coming out, as well as retail sales. So if Powell is dovish or concerned about the economy, that's going to give us a pretty big heads up on what those CPI numbers and retail sales are going to look like coming the next day. Now, I got to be honest with you guys. I'm pretty concerned about the state of the economy right now. The similarities and parallels to what you've seen back in 2007, early 2008, where the consumer, once we start, and I mean we as in consumer, me, you, everyone else, when you start to really slow down, it happens quickly. Back in 2007, you went from September, things were fine, people were spending money, to Ben Bernanke was warning Congress of a slowdown in November, and then the data went down the poop chute by January of 2008. Within 3 months, you went from great to, oh crap, this is terrible. And another big similarity from now and 2007, just comparing the two, is back then there was a lot of inflation in energy prices, which had a big impact on the consumer. And that's one of the biggest reasons why you actually seen such a steep recession like you did. Obviously, the banking crisis was part of it, but energy really just stopped spending. It was $5 a gallon here in Michigan for gas. On inflation-adjusted terms, I mean, that's like $8, $9 a gallon here. The difference today and the similarity from then is now it's not just energy that's expensive, it's everything that's expensive. The biggest difference to today compared to then is people were flushed with a lot of cash in the last couple of years. So it's taken some time to wear down. But you're now at that moment where most people are out of savings. It was reported last week that 60% of households are completely out of savings. And again, judging off of this poll that I put on the YouTube, 55% of you guys, consensus, thinks the economy is bad and they're cutting back where they can. And remember, you guys are watching a finance YouTube video about stocks in the stock market. The average person is not. So one, congratulations. You're well ahead of the average person or average family if you're watching these videos. That's great. But if you're saying you're cutting back, just imagine what the average family feels like right now. And I think that is the biggest thing that is concerning to me. What's also very concerning is stocks are nearly at all-time highs. There is a 0% chance of a recession baked into our markets, judging off of where stocks are. Those odds are going to rise. Now, where do they rise? Do they rise to 50%, 30%? I don't know, but that means downside for markets. With that said, I should acknowledge Tesla stock is down a lot. Other stocks are down a lot. I think some stocks are already pretty well priced for a recession, including Tesla. So if the markets do get worse from here, Tesla stock can obviously fall, but I think you're better priced for some kind of recessionary environment in Tesla stock today at $167.52. So I would argue that maybe you don't see as much downside. Then again, keep in mind the Fed would start cutting rates probably by July, in my personal opinion. And well, that could be a positive for Tesla. I do have a special video coming out at 8 p.m. tonight about all of this, what you need to know about the economy right now, what's going to happen to the markets here soon, and potentially how to hedge your portfolio. I actually share with you in that video, I probably shouldn't have, but a once in a decade potential trade, at least trade idea. Obviously, you can lose all of your money if you listen to anyone on YouTube, and that's not financial advice. Contact a financial advisor if you need to, all the typical disclosures. But there is a real opportunity if you can spot what's about to happen. So make sure you guys check that video out, coming at 8 p.m. Eastern Standard Time tonight. And what we talk about in that video at 8 p.m., part of which is the Fed that is totally asleep at the wheel right now. So that's why I think next week's going to be very important, because I want to see, is Jerome Powell also asleep at the wheel, or does Jerome Powell have some senses? Fed Bowman said on Friday, yesterday, I don't see rate cuts as warranted this year. When in all reality, I think the Fed should take the parallels between 2007 and today, another one of which was companies back in 2007 were warning about the consumer slowing down in 2007. And that's exactly what ended up happening. That's what's happening today. Nike, Starbucks, Walmart, Target, Dollar General, you name it. And that company in which you name probably warned about the consumer. But apparently some Fed officials are asleep at the wheel. Game of Trades writes on X, history tells us that this is the calm before the storm. More inversion days equals deeper drawdowns. We're already at 550 days. This has only occurred 3 times. 1929, Great Depression. 1974, hyperinflation. 2008, great financial crisis and the banking system collapsing. He says all 3 ended in sharp market down draws. So we are now, based on this chart, we've been more inverted now for a longer period of time than you were in 2008. On another note, the Cybertruck and the Model 3 Performance are making their debut in Macau this weekend. Tesla's global inventory numbers are at about 7,200 for the Model Y. I'm interested to see if you start to see inventories fall following this news that came out today about, call it 1% APR financing. Now you are seeing the Model 3 inventory spiking a little bit more, up to about 2,650. Model X inventories at about 2,500, and Model S inventories at about 1,300. Tesla seems like they have found their sweet spot with Google, continuing to run about 4,000 different ads for months now. Shorts continue to double down on their short positions in Tesla stock. You do have short interest of free flow at 3.87%, $18.45 billion currently in those short positions. You have 107.3 million shares that are currently sold short. Cost to borrow fees on Friday were about 10%, which suggests there was a lot of shorting activity taking place on Friday, which you can tell from the outflows over 400 million that there was probably a lot of shorting that did take place. Now, at the same time as I'm kind of warning about the economy, about the markets here, the shorts unwilling to cover on their short positions in an automaker, that's also kind of a red flag, because automakers are perceived to do really bad during recessions, and typically they do. I think Tesla now appeals to a consumer that has a little bit more money anyways, so maybe they're not going to be the first that is hit during some kind of recessionary event. And I think, simply put, Tesla stock is already priced for a recession. But still, seeing shorts adding to short positions when Tesla is in the 160s is kind of concerning. Not for Tesla specifically, necessarily, but for just the state of the economy and what could come next. The perceived weakness that could come to the economy. On Friday, this article came out from one of the top economists in the world. He says the US may be sleepwalking into a recession as cracks form in the labor market. The economy is flashing warning signs that suggest a downturn is on its way, according to David Rosenberg. The top economist pointed to a weakening job market and a slowdown in manufacturing activity. Several financial models are already sounding the alarm for a hard landing, he added. Top economist David Rosenberg says, quote, "We're constantly asked when we're planning to throw in the towel on our recession call, but perhaps it's time folks started asking when the rest of the street is going to pick their towels back up," Rosenberg said in a note this week. "We've seen a downdraft in the data flow that is starting to indicate that the downturn in the economy may not be as far away as many believe." He says the job market, for one, has continuously weakened over the past year. The unemployment rate remained near a 2-year high in April, ticking up to 3.9%. That means the job market is even closer to triggering the SOM rule, a, quote, gold standard metric of a coming recession that flashes when the 3-month moving average of the unemployment rate rises 0.5% above its 12-month low, Rosenberg added. Economic activity is also starting to show. GDP came in softer than expected over the first quarter, with the economy growing 1.6%, well below the previous 2 quarters' growth. And I reported the day that GDP came out, the estimate for GDP was around 2.5%. So that was a big miss. Manufacturing activity contracted in April, the 17th contraction recorded out of the last 18 months. That's a strong sign the economy is weakening, as manufacturing has only contracted on 2 occasions since 1997 without the economy later slipping into recession, Rosenberg noted. Popular recession models have already signaled a downturn may be on the way. The 2- and 10-year yield curve, a notoriously accurate recession indicator, has signaled a coming downturn since July of 2022. Full model, which estimates the probability of recession over the next 12 months, is showing that the US still has nearly a 50% chance of tipping into recession over the next year. Which, if you take a look at the 10 and the 2-year yield curve inversion, it's still inverted 37 basis points. When you actually start to see this rise and uninvert, that's when the pain in the markets likely comes. Recently, this has been just sideways. And essentially, that's the argument that I'm making. If the odds of a recession are really closer to 50%, today the markets are assigning 0%, even without going into a recession, just a slowdown. And the perceived higher chance of a recession will cause stocks to sell off, maybe 20+% from current levels. I will note, I think I'm very early on this. I think it could take 4 weeks, 2 months before the markets start to pick up on what I'm saying here. And that's why I'm really making this video. There's no sense in talking about things that are already happening. I want to get you guys ready for what could happen, what will happen. This is not a question of will it happen, it's when does it happen. And I think it's probably sooner rather than later. So if you have months to now prepare for this, a month, 2 months, you're going to be in a much better place than if you wake up one day and you're blindsided by the economy heading into a recession, or recession odds are rising. And yes, I know this video, at least this part of the video, is not going to be popular. People are not going to like this. I understand that. You want to be bullish on markets generally over the long term. But with these specific scenarios, there can be periods of time, a couple of years, where markets just don't do well. if you do go into a recession. Now, that's not exactly what I'm calling for. Keep in mind, it is an election year. We talk about a lot of this more in depth in the next video coming out at 8 p.m. tonight. Again, stay tuned to this channel for that one. You definitely don't want to miss it. It is an election year. And this once in a decade trade, part of it is not dictated on that, but part of that trade that I do share at 8 p.m. tonight is it is an election year. The government's going to do whatever they can, or try to do whatever they can, to keep the economy out of a recession. Because if you don't, well, you're going to lose the big house. You're going to lose the White House. There's only been one president that has ever won a re-election within a recession happening 2 years prior to an election. So people kind of hold a grudge, if you will. Even if you had a recession in 2022, Biden's odds of winning the presidency in 2024 are very, very low, let alone if it happens right before an election. And that president that won a re-election within a recession happening 2 years before a new election was William Taft back in 1913. There has been 6 other presidents that have tried, and all of them have lost. So long story short, I think you'll be looking at 50 basis point rate cuts, 75 basis point rate cuts, maybe 1% rate cuts at Fed meetings if we do actually start to go into a recession. Because at that point, inflation will fall anyways, because inflation is really just a metric of consumer spending activity. If consumers stop spending and they stop buying a product, companies don't raise prices anymore. They can't. So I think the bigger problem could actually be deflation, which is worse than inflation, and yeah, that would be a whole nother can of worms. But back to this article briefly. The last thing we're going to talk about in regards to this, again, we have a lot more coming out later on today on this entire topic. In fact, the next video is basically all about this. Rosenberg says, don't get complacent. The labor market is cracking. A slowdown in services activity is dragging on real-time growth, and forward-looking financial signals still point to a coming slowdown. Sentiment for the SPY over on StockTwits is extremely bearish, sitting at 23. On Thursday, or on Friday, you were sitting at 42. So even over this weekend, people are getting more bearish. Sentiment for Tesla is also getting more bearish currently, but not by nearly as much. Yesterday, you were neutral at 45 for your sentiment number. Today, you're bearish at 43. So a little bit more bearish, but really not a big deal. Message volume is actually increasing from yesterday's number of 46 to 47 today, and the participation ratio today is 54, which is considered normal. Google Trends data for the Tesla lineup continues to show another large spike for the Cybertruck, recently going from 57 to 66. The Model Y going from 26 to 28. You do have the Model 3 going from 25 to 23, as well as, the Model S going from 12 to 11, and the Model X staying right at about 9. Percent of stocks above their 50-day moving average on Friday was down about 2.64%. 1.5% of all stocks on the markets fell under their 50-day moving average on Friday. That's not great, but that's not an utter collapse at the same time. You did see on Friday, the Russell 2000 was by far the biggest lagger, did the worst. You had the Russell that was down 0.67%, the NASDAQ, which was down 0.03%, S&P was up 0.16%, and the Dow Jones Industrial Average was up 0.32%. Your Treasury yields on Friday were also up about 5 basis points, back to about 4.5%. This was mostly because of Fed speakers that sounded, well, like they're asleep at the wheel. That maybe we need to raise rates again because we're not even at neutral. Which in all reality, the economy is likely slipping into a recession as we speak, as the consumer slows down. I think the Fed forgets 74% or so of today's economy is driven off of consumer spending behaviors. I mean, by any metric you can look at, the Fed is now officially asleep at the wheel. If you take a look at Tesla stock on a technical basis, as I said earlier, you did break under that 50-day moving average. You found support at the 20-day moving average in regular trading. And after hours, you fell under the 20-day moving average, which is currently sitting at $167.75. In after hours, Tesla stock closed about 20 cents lower than that at $167.52 per share. I'm not going to make a big deal about that. I think you may or may not hold support at the 20-day moving average. 20 cents in after hours doesn't make a huge deal for that, in my personal opinion. If you hold the 20-day moving average as support, fantastic. If you don't, big deal. You then will fall to about 160, and then if things get bad, or when they start to get bad in the markets, then you're going to fall back into the 140s and eventually probably lower than that. And when that happens, I will look at it as a great buying opportunity for Tesla stock. If you take a look at the RSI is currently at 47.43, so slightly under neutral, which I mean is kind of surprising given we've just seen Tesla stock selling off for 4 days in a row, and you're pretty much still neutral, which I find surprising. The MACD line is still positive 1.5, and the signal line is still positive 1.04. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. Again, if you guys want to come trade with us live in real time, get access to the specific trades that I am making, including what could be a once-in-a-decade opportunity, well, check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.